Hello everyone, welcome back to our Accounting 210. In this video, we continue with Chapter 10 Performance Evaluation. We are continuing with the learning objective 3, calculate ROI, sales margin, and capital turnover. If we did all of this last time, but we still have one measure we didn't get the chance to do. Very important also is called residual income. So we will finish this part in this video. Let's look at what is residual income. Residual income. Okay, how do we understand this terminology? I use personal life. Let me ask you a situation, right? Okay, so sorry. Get a color. I want to. Let me ask you a question. You said, hey, professor, your class is so boring. I'm so done with accounting. I'm also so done with my class. And then what I will do is I want to have my own business. All right, so I want to be a millionaire. I want to earn money. And then how to start that? So first step is you borrowed 100,000. Let's say you borrowed 100,000 from the bank, right? So you said, okay, I'm going to start my own business. I'm done with the school. But does the bank give you money for free? Most likely no, right? Bank will say, okay, then okay, you can get the money, but you have to pay me 10% as the interest. Okay, so in the first year, you did very well. Okay, so you used 100,000, you invested, you do business, and then at the end of the year, you got 120,000. Let me say you got 120,000 as your operating income. My question is, does this is your net income? I want to ask you, will these 120,000 all belong to you? Your answer is, hey, let me think about it. You got 120,000. First thing is what you need to do. You need to first pay bank your interest, right? So here you got 120,000, but it doesn't belong to you 100%. You have to first pay for the 10% of that 100,000. So the actual money left for you is only 110,000. That will be called as the residual income. It's the income, but it's the residual. So your residual income equals to your original income minus the money you first need to pay to cover your return. You first need to pay to cover your return. So in this situation, you are doing fine, you are doing well, all right? So your residual income is 110,000. So we want the residual income to be higher. That means the left money for yourself, the residual is high. That's all. That's the meaning of residual income. It's the income residual left to yourself, So before you understand how do you use the formula, you have to know there is one thing first. We use this one is 10%. What's the meaning of this 10%? This 10% is target of the return. This is the minimum accepted rate of return to get for the division to earn on its assets. Okay, so the residual income will be the division has created extra residual income above and beyond the expectation. It compares the actual operating income with the minimal operating income that to management expect given the size of the assets. Okay, given the size of the assets. So you have the required target of return, which is 10%. In our example, is we minus the money you borrowed from the bank. But in this chapter, we use our total assets. We use our total assets as the money you borrowed. Therefore, our overall formula will be your residual income equals to your original income minus your assets time the return, time the required target of the return. Okay, so in our example, we said we assume the return is 25%. Now let's look at our two division and see which one is doing better. For our beverage, right, we said it's your income minus the assets time the return. We said for this return is 25%. The gross income, before we talk about the return for our beverage is, we said is 2,785, and then we minus the assets. Remember, we have the assets, we times 25%. And then for the snack, it's this operating income minus the assets times the 25%. So I'm just doing the number here. It equals to your income is 2,785 minus 2,8,128 times 25%. Guess what? Guess what? It's even negative. It's even negative. It's negative 4,247. So you borrowed the money, kind of, you didn't even generate enough income to cover your required return. Okay, so for the snack, I'll give you another example later. For our snack, is your income, which is 4,304 minus your assets 5,375 times 25%. We get what? We get positive 2,960. So you covered the required return and you still have some positive income. Similarly with this situation is you borrowed 100,000, so that is kind of like the assets. You totally got 120,000. So you first covered the 10,000 and you still have a positive left to yourself. Another situation, another scenario is that you didn't do well, right? That you didn't do well, let's say. So you borrowed 100,000, bank said, hey, it's 10%. But at the end of the year, you only got 8,000 for whatever reason. You borrowed 100,000, then the required return is 10%, but your income is you only got 8,000. Now your residual income will be your 8,000 minus this 100,000 times that 10%. In this situation, is 8,000 minus this 10,000. Guess what? You have a 2,000 loss. So your income, your original income, is not even enough to cover the required interest. So for your beverage, similarly for your beverage, you invested this much money you require for 25%. Unfortunately, your original income is so low, it even couldn't cover your required return. That is why you have a negative residual income. For the snack, right? You got this much money as assets, require 25%. Your original income is more than enough to cover the required return, and you still have 2,960 left as the residual for your sales. So we can see definitely your beverage department is doing much worse than the snack. Sorry, hard time to just tell the difference of snack. I need to think twice to cover on the second this investment center. So we want the residual income. We said higher means better. That means your income does not just cover the required return. You still have some positive residual left to yourself. Okay, then I stop here. I believe in your textbook, it also talk about something called the Gould congruence. So I'm not going to test you in our class because we don't want to put too many things in the summer. We have a very tight schedule. I'm not going to test you, but just to read get some idea. I don't know you have this one in the lab assignment, yes or no. If you do have this assignment, I will give you the solution. So do not worry too much about this Gould congruence concept. Basically, it tells you if you use ROI, it doesn't meet the Gould congruence, but if you use the residual income, then it will align all everybody's interest together. That answers the question. So if you already have ROI, why we still learn the ROI? Because ROI has its advantage. It will reach the Gould congruence. Okay, so I stop here with the learning objective 3. I think we talk about these 3 measures. Make sure you know ROI, and then you know also the sales margin, and then you also know the capital turnover. You know the relation, right? The ROI equals margin times the turnover, and then you also need to know what's the meaning of residual income. Okay, thank you. Let me know if you have any question. We will skip learning objective 4 and we talk about learning objective 5. Very important part. I see you in the next video. Thank you.